Hello, my name is Jay McCabe and I'm a commercial banker with Comerica Bank, and this is Ask the Banker. In this episode, I'll give you my take on the question, what factors does a bank consider when offering a loan without a personal guarantee? Before answering the question, let me first provide some context by defining a personal guarantee and discuss why banks often require it. A personal guarantee is a legal contract requiring an individual, typically an owner of the business borrowing money, to personally repay a loan in the event the business is unable to do so. It's helpful to know that personal guarantees come in many different flavors. The most common is probably the unlimited guarantee, in which each guarantor is liable for paying the entirety of the loan's principal and interest. There are also limited guarantees, more common for businesses with multiple owners, where the guarantee could be capped based on a percentage of ownership. These are only a couple of examples. The point is that guarantees can be customized depending on the circumstances. Bank financing is one of the most cost-effective forms of capital. One reason for the lower cost is that bank loans are structured to reduce the probability of a loan loss. This is accomplished by underwriting and structuring the loan to allow for multiple sources of repayment. Typically, the first source is the cash flow of the business. Should this fail, the bank will pursue a secondary source such as business collateral. This could include accounts receivable, inventory, equipment, or real estate. If this source is insufficient, and sometimes simultaneously, the bank will pursue another source, such as the personal assets of the guarantors. Now, circling back to the original question, a bank will consider the size of the business, the contributions of the owner on the company's performance, and the purpose of the loan. Regarding size, the bank will evaluate the income statement noting revenue and profitability trends of the company. Has the performance been consistent and growing? Is the performance sufficient to cover the size of the loan? The bank will also consider the balance sheet, noting the use of profits. Have the profits been reinvested into the growth of the company, or have the owners distributed the profits? The bank will also consider the dependence of the company's performance on the contributions of the owner. Does the company have management team depth and experience beyond the owner? What impact would it have if the owner was suddenly no longer involved in the business? The bank will also evaluate the purpose of the loan. A line of credit that is well supported by working capital assets or a term loan supported by saleable equipment are less risky than a loan used to acquire another business or finance a shareholder buyout. The line of credit and equipment term loans are well supported by collateral, whereas the acquisition loan or shareholder buyout are not. It is more likely that the acquisition loan or shareholder buyout loans will be supported by some form of personal guarantee. I hope you found some value in this video. If you have any questions, please write them in the comments or send me a direct message. My name is Jay McCabe and I'm a commercial banker with Comerica Bank, and this is Ask the Banker.